So think about this for a second. If you walk into a casino, right,
Mm.
and you sit down at the roulette table and you put your chips on red or black.
Right, the classic, basically a coin toss.
Exactly. It's practically a 50-50 shot.
Mm.
So if we look at the financial markets where a stock or a currency basically just goes up or down,
Yeah.
how is it statistically possible that 95% of retail traders consistently lose their money?
Yeah, I mean, when the mechanics of the game offer essentially a coin flip probability, a 95% failure rate just shouldn't be mathematically possible.
Right.
The numbers basically suggest the environment itself is actively working against the participant.
Which, naturally leads people to assume the game is rigged by the house. We always hear about Wall Street algorithms front-running the little guy or institutional manipulation.
Oh, for sure. That's the common excuse.
But what if the game isn't rigged by the institutions at all? What if it's actually rigged by your own biology?
That is the big question.
Right, so today's deep dive is into this wildly counterintuitive world of high-stakes trading. We're looking at the book Best Loser Wins by Tom Hougaard. And, I mean, Tom isn't your average trader.
Not at all.
While a typical retail trader might risk, say, $10 per point of market movement, Hougaard routinely risks up to $3,500 per point.
Which is just insane. I mean, managing that level of exposure demands an almost superhuman level of psychological resilience.
Yeah.
The sheer physical stress of watching a position fluctuate by tens of thousands of dollars in a matter of seconds, it would completely crush most people.
Oh, absolutely. But just to be clear, our mission today is not to give you financial advice. Far from it, right?
Right. Definitely not financial advice.
We're going to decode the human brain. We're going to explore why your natural evolutionary instincts practically guarantee failure in high-stakes environments.
Yeah, and how that top 5% of performers achieve outsized success by doing, like, the exact opposite of what human nature demands.
Exactly. And Hougaard's insights are so compelling because, they aren't just academic theory.
No, they're forged in the fire of real-world observation. His journey is actually pretty fascinating. It started when he was recovering from an illness and read Michael Lewis's book, Liar's Poker.
Oh, classic.
Right, and that just ignited this sudden passion for the markets. Then, in 1992, he experienced what's known as Black Wednesday, when the British pound crashed.
Right, out of the European exchange rate mechanism.
Exactly. And by pure chance, he had exchanged a sum of Danish kroner at a highly favorable rate during all that chaos.
Wow.
It created this financial windfall that basically paid off his entire university debt.
That is quite the dramatic introduction to the power of currency fluctuations.
Seriously, and it completely altered his trajectory. He got 2 degrees, studied economic theory, and eventually started at JP Chase.
Okay, so he's deep in the institutional world.
Right, but the real crucible for him, the thing that shaped this book, was the decade he spent working in London for CFD brokers.
Great contracts for difference.
Exactly. And for those who might need a quick refresher, CFDs essentially allow retail traders to make these massive, highly leveraged bets on price movements without actually owning the underlying asset.
So it's a pure speculation.
Pure price speculation, yeah. And Hougaard wasn't just trading there. His job was to act as an educational bridge between the brokerage and its retail clients.
Okay.
So over 10 years, he watched over 100,000 clients execute nearly 100 million trades.
Wait, 100 million trades? That is an insane sample size.
It's massive. You really can't argue with the data at that scale.
You really can't.
And the sheer consistency of the failure he witnessed is staggering. To put that 95% failure rate into like a relatable perspective, Harvard University has an acceptance rate of around 4.5%.
Right.
The success rate of a retail trader trying to navigate the financial markets is mathematically identical.
Wow.
You have the exact same odds of getting into Harvard as you do of surviving as a day trader.
That is wild. Okay,
Yeah.
So let's look at the psychology behind that elite 5% who actually do survive.
Yeah, let's do it.
Because when we hear that only a tiny fraction survives, the default assumption is that they have some, unfair structural advantage.
Right, like they must have faster algorithmic software or insider information.
Exactly, or some proprietary charting method that the rest of us just don't know about.
And brokerage marketing departments spend millions of dollars to keep you believing that narrative.
Oh, for sure.
They sell this illusion that success is built on better tools or, hundreds of overlapping technical indicators and complex programming.
Buy our software and you'll be the 5%.
Exactly, but Hougaard's core realization, gleaned from watching those 100 million trades, was fundamentally different.
Okay, what was it?
The market isn't beating the 95%. The 95% are beating themselves.
Oh, wow. Okay, so what does this actually look like under the hood? Why are we our own worst enemies the second money is put on the line?
Well, to understand that, we have to look at the neuroscience of how human beings process threat.
Right.
Back in the 1960s, neuroscientist Paul MacLean proposed the concept of the triune brain. It's the idea that our brain evolved in 3 distinct layers over millions of years.
Okay, I've heard of this.
Right, so at the top, you have the neocortex. This handles logic, rational thought, mathematics. This is the voice in your head doing the backtesting, the part you actually think is in charge.
The logical trader.
Exactly. Below that is the limbic brain, which deals with emotion, memory, and importantly, social belonging.
Okay.
When a brokerage runs a commercial showing a trader stepping out of a BMW, they are completely bypassing your logic. They're targeting your limbic brain's deep desire for tribal status.
Oh, that's classic advertising. Join our platform, achieve high status, become the alpha.
Exactly. But beneath both of those layers sits the reptile brain, the basal ganglia.
The really old hardware.
The ancient hardware. This is the primitive subconscious center that controls our fight-or-flight response. Its sole evolutionary directive is just to keep you alive.
Right.
And here is the fatal flaw for traders. When capital is put at risk, the brain perceives it as a literal mortal threat.
Wait, like a physical threat?
Yes. The neocortex, your logic, effectively goes offline, and the reptile brain violently takes the wheel.
Wow. And here's where it gets really interesting in the text, actually. Hougaard highlights a specific neurobiological quirk.
Right.
He notes that humans experience a financial loss 250% more intensely than an equivalent financial gain.
Yeah, that's a massive multiplier.
And the wild part is, this is true even if the loss isn't realized yet. Just watching your position go negative on a screen triggers a visceral, physical pain response.
And that intense biological reaction makes perfect evolutionary sense, right?
How so?
Well, if our ancient ancestors found an extra bushel of berries, they were full for the day. That's a gain. It's nice.
Like a bonus.
But if they lost their only supply of food for the winter, they died.
Oh,
We are literally hardwired to treat loss as an existential crisis. That 250% loss aversion rule is the invisible engine driving the failures of the 95%.
so it just overrides everything.
Completely. The intensity of that pain causes an otherwise intelligent, totally rational person to act incredibly impulsively just to make the pain stop.
Okay, but I'm going to push back on this logic for a second.
Sure.
Because if the reptile brain is designed by evolution to protect us from danger, shouldn't it make us more cautious?
You would think so.
Right. Shouldn't that intense, agonizing fear of loss make us better at saving our money, like forcing us to cut our losses immediately to eliminate the threat?
That would be the logical reaction, yes.
Because it sounds like we treat the stock market the same way we treat a supermarket. Like, if a premium cut of steak drops in price by 25%, our brain screams, bargain, buy more.
That is a perfect analogy. And validating that supermarket effect is really crucial to understanding the pathology of the losing trader.
Okay, unpack that.
Well, in the grocery store, the fundamental value of the steak hasn't changed, right? Only the price has. So a drop genuinely represents a bargain.
Right, you're getting the same calories for less money.
Exactly. But in the financial markets, supply and demand dictate reality in real time. Just because an asset has fallen in price does not make it cheap. It might just be failing.
Oh, yeah, that makes sense.
But the 95% completely fail to make that distinction. When a trade drops and goes against them, their brain basically short circuits.
Because of the pain.
Right. And instead of taking the small loss to protect themselves from further harm, they apply that supermarket logic. They add to their losing position.
I see. They're desperately trying to average down their entry costs so they can bounce back to break even faster.
Exactly.
They just want to get back to zero so the pain goes away.
They are trying to negotiate with their own pain because the moment they close the trade, the loss is crystallized.
It becomes real.
It becomes real and the pain is permanent. By keeping the losing position open and throwing more money at it, they keep the outcome ambiguous.
Whoa.
They are completely paralyzed by hope, and in the context of trading, hope is a wildly toxic emotion.
Because it keeps you in a bad situation.
Exactly. They sit there staring at the screen, watching the red numbers grow larger and larger, completely frozen by the fear of realizing the loss, just praying the market will miraculously turn around and rescue their ego.
Man, that sounds exhausting.
It really is.
So how does Hougaard actually execute mechanically then? Like, if our brains are literally hardwired to self-destruct under financial pressure, how does he or anyone in that elusive 5% function day to day without their reptile brain driving them off a cliff?
Well, it requires a profound, highly intentional level of mental conditioning before the market even opens.
Okay, what's his routine?
Hougaard wakes up at 5 a.m., and he doesn't walk into a trading floor filled with, flashing water-cooled computers and banks of Bloomberg terminals.
Not the movie stereotype.
No, his setup is remarkably simple. Before he looks at a single chart, he opens a basic PowerPoint presentation.
A PowerPoint.
Yeah.
That sounds more like a corporate quarterly review than like high-stakes trading preparation.
I know, but it serves as a psychological mirror. This PowerPoint is a carefully curated collection of his past mistakes, his triumphs, inspirations, and specific, really harsh warnings to himself.
Like what?
For instance, he forces himself to review screenshots of past trades where he held on too long out of stubbornness and blew a massive profit.
Oh.
And he puts bold text next to it, reminding him of the physical sickness he felt that day.
Wow, so he's intentionally triggering the pain.
Exactly. He compares this morning routine to the movie Gladiator, specifically the scene where Maximus rubs dirt into his hands before walking into the arena.
Oh, I love that movie. But Maximus isn't doing it for grip, right? He's doing it to transform.
Yes.
He's shedding his identity as a farmer or a general and basically becoming a weapon.
That's exactly it. Hougaard is performing the exact same ritual to leave his old self behind. Because if he doesn't immunize himself against the emotional pain before the opening bell rings, his reptile brain will take over the second he sees red on the screen.
He has to become an emotionless instrument.
Precisely. He's essentially recoding his brain's automatic responses. And this recoding is built on 3 specific commands he adopted after studying under a master trader at the Chicago Mercantile Exchange.
Okay, let's unpack the first command. The book says you must assume you are wrong until proven right.
Right. And this completely flips the baseline expectation of the 95%.
How so?
Through his years of observation at the CFD brokers, Hougaard saw that the typical retail trader enters a position assuming they are brilliant.
Right, of course.
They've done their technical analysis, they've drawn their trend lines, they feel incredibly confident, and they fully expect the market to validate their intelligence immediately.
But wait, doesn't starting your day by assuming you're wrong completely destroy your self-confidence?
It sounds like it would, yeah.
Because whether it's in business, sports, or just life in general, society constantly preaches self-belief. Like, back yourself, trust your gut.
Sure, but consider the mechanics of what happens when that typical self-confidence hits the reality of the market.
Okay.
When the 95% enter a trade expecting to be right, and the market instantly turns against them, it creates massive cognitive dissonance.
Right.
The conflict between their confident expectation and the harsh reality of the flashing red numbers causes that brain short circuit we talked about. They freeze up because their ego is under attack.
Oh, I see.
By assuming he is wrong from the very start, Hougaard completely neutralizes that inner conflict.
Because the market is just confirming what he already assumed. There's no shock.
Exactly. Because there is no conflict between expectation and reality, and therefore no wounded ego, he can take the loss immediately.
That's brilliant.
He operates without panic and without the paralysis of hope. He just cuts the trade and moves on. Accepting the pain instantly keeps the loss remarkably small.
Okay. The math of handling a loss totally makes sense now. Like, if you expect to be wrong, a small loss is just the overhead cost of running the business.
Exactly.
But winning should be the easy part, right?
Okay.
You're making money, the ego is stoked, the account balance is growing. Why is winning actually where things fall apart?
This is perhaps the most counterintuitive part of his entire philosophy. And it brings us to command 2. Expect to be uncomfortable.
Good.
The 95% seal their fate when they're winning because the fear of losing the money they just made is actually more agonizing than taking a loss.
Wait, really? The anxiety of paper profits?
Yes, exactly that. The moment a trade goes into the green, the trader's anxiety spikes astronomically.
Interesting.
They start agonizing over the idea that the market will suddenly reverse and snatch away their hard-earned gains. Their protective reptile brain starts screaming, "Secure the resources! Take the money and run!"
Just to end the anxiety. So they close the position early, likely chanting that old Wall Street justification, you can't go broke taking a profit.
Right, which is a terrible justification. Because they aren't exiting the trade because the market structure shifted, or because a technical indicator signaled a reversal. They are exiting solely to end their own internal emotional discomfort. They are prioritizing psychological relief over optimal trading strategy.
Wow. It's like jumping out of a perfectly good airplane with a parachute just because you're worried the engine might fail 20 miles down the road.
That's a great way to put it.
Like, sure, you survive the immediate moment, but you completely ruin the trip. You're trading your own emotional state, not the market in front of you.
Exactly. They survive the moment, but they guarantee long-term failure. Because their winning trades are consistently capped at these tiny amounts, while their losing trades, as we established with the supermarket effect, are allowed to grow massive out of hope.
Right.
It's an inverted risk-reward ratio.
Yeah.
The math just disintegrates over time.
Which perfectly sets up Command 3. Add when you subtract, and subtract when you add. This is the behavior of the 5%, right?
Yes. The elite 5% expect that massive wave of anxiety when they are winning, and they actively flip the switch.
How do they flip it?
Instead of reducing their position or snatching a small profit early to feel safe, they do the unthinkable. They add to their winning positions.
They double down when they're up.
Yes. If the market is proving their thesis right, they buy more. They use the pain and anxiety of potential loss as a compass, not a stock sign.
That takes nerves of steel.
It really does. But they deeply understand the mathematics of their strategy. To pay for all those small, frequent losses they take by assuming they are wrong, they have to relentlessly maximize their winners.
You gotta let them run.
Right. They run toward the danger, riding the trend and leaning into the agonizing discomfort until the market actually dictates an exit.
Okay, the math definitely makes sense. You maximize winners to pay for the small losses.
Yeah.
But running toward financial danger is completely unnatural. There has to be a severe psychological barrier keeping the other 95% from just copying this strategy. Like, what stops someone who has read the book from actually executing it?
Honestly, the most primal roadblock is sheer, unadulterated fear.
Fear.
Yeah. Hougaard shares a very personal anecdote that brilliantly illustrates how fear physically paralyzes us.
Oh, the swimming pool story.
Right. He was on holiday, fully clothed in a business suit, sitting by the pool for a meeting, and suddenly his young son fell into the deep end of the pool.
Terrifying.
And there were 4 other adults right next to the child, plus a trained lifeguard on duty.
And everyone else just froze.
Time stopped. The other adults and the professional lifeguard were completely locked up by the sudden shock and fear of the moment.
Wow.
But Hougaard, sitting 20 meters away, leaped over 4 sun loungers and dived in feet first, suit, shoes, and all, to pull his son out.
He recognized the threat before his body had time to process the fear.
Exactly. And he realized later that this physical response is exactly what is required in trading.
You have to act instantly.
You have to recognize the situation and react before the fear paralyzes your motor functions. You have to take the loss quickly, jumping in before the dread of a massive financial hit freezes your hand over the mouse.
That's such a visceral image.
It really is.
But there's another roadblock he mentions that really fascinated me, because it has absolutely nothing to do with fear.
Right.
Guilt. Specifically, the guilt tied to the Protestant work ethic.
Oh, this is a huge one.
Because we are programmed from birth, right, through school and corporate jobs, to believe that we must always look busy to be valuable. Like motion equals productivity.
Yeah, and this is a massive psychological mismatch for traders. In almost every conventional profession, you are compensated for your time and your physical or mental activity.
Right. You get an hourly wage or a salary.
Exactly. And if you are sitting idle at your desk, society tells you that you are wasting time and stealing from your employer. But the financial market does not pay an hourly wage.
No, it doesn't. So traders feel this immense guilt just watching the screen and doing nothing.
Yes.
They feel this intense pressure to manufacture a trade just to justify their time in front of the monitor.
Exactly.
They make bad bets purely to satisfy a societal conditioning that says, I must be working.
It's crazy, but sometimes the most profitable action a trader can take over an 8-hour session is absolute Total physical inactivity.
Just sitting there.
Sitting on your hands requires immense discipline when your brain is demanding action.
Yeah, I bet. So let's talk about the danger of market logic. I really want to look at the story of Christmas Eve 2018.
Oh, this is a perfect example.
Right. The Dow dropped almost 800 points. And Hougaard was heavily shorting the market and basically made an absolute fortune while sitting down for his Christmas dinner.
He executed brilliantly that day. I mean, he felt like a genius, and the immense profits flooded his system with confidence.
Which is dangerous.
Extremely. Because 2 days later, on December 26th, the market staged its biggest one-day rally in history. It just launched upward. Wow.
And Hougaard initially caught some of the upward momentum, but then he started shorting it again.
Why? Why would he short a rally like that?
Because he assumed the market had to be logical. He looked at the charts and thought, it just crashed historically. It cannot possibly sustain a rally this aggressive.
He overestimated the rationality of a system driven by human panic and greed. Like, he thought the market had a memory.
Exactly. But the market is fundamentally illogical. The old economic adage rings true. The market can remain illogical far longer than you can remain solvent.
Right.
His overconfidence from the Christmas Eve win made him abandon his foundational rule. He forgot to assume he was wrong, and he paid for it.
Which brings us to the culmination of his philosophy, the breakthrough moment he calls the 100,000-pound day.
Yeah, this is a great story. This was a session where the market trended downwards relentlessly from the open all the way to the close.
Just a straight drop. Right. And Hougaard held short positions the entire time, aggressively adding to them as the market fell. But his biggest takeaway, at the end of the day, had nothing to do with the 100,000 pounds sitting in his account.
It was a profound realization about his internal state, right?
Yes.
He realized he hadn't felt fear the entire day.
Not once. He achieved a complete flow state. He stayed entirely in the present moment. He was so attuned to the rhythm of the price action that he wasn't battling his reptile brain for control.
Right.
He just kept mechanically adding to his winning positions as the market proved his thesis right. And crucially, not once did he try to guess the bottom so he could buy in cheap and reverse his position.
He entirely abandoned the supermarket mentality.
Completely abandoned it.
So what does this all mean for you listening right now? I mean, Best Loser Wins is not just a catchy title meant to sell books.
No, it's not.
It is a literal blueprint for a biological hack. Success in extreme high-stakes environments isn't about spending 25,000 hours staring at candlestick charts until your eyes bleed.
Definitely not.
And it's certainly not about buying a $5,000 predictive software package. It's about accepting the agonizing pain of risking capital.
Yeah.
It's about violently giving up the ego-driven need to be right all the time. And it's about recognizing that hope, when it comes to navigating probabilities, is actually the enemy of survival.
It really requires a continuous daily war against your own deeply ingrained evolutionary defense mechanism.
And you don't have to be a high-stakes day trader to apply this framework either.
Right.
Think about your own life. Where in your career, in your business negotiations, or, maybe even your personal relationships, are you letting your reptile brain force you into a catastrophic decision just to avoid a few minutes of psychological discomfort?
That's a great question.
Where are you stubbornly holding on to a losing hand, totally paralyzed by hope, just waiting for the universe to miraculously turn around and save your ego?
That is the ultimate application of Hougaard's work. And it leaves me with a thought I'd really love for you to mull over after this deep dive ends.
What's that?
Well, if human biology dictates that we feel every loss 250% more intensely than an equivalent gain, what if the ultimate shortcut to success in life is simply building up an immense tolerance for looking foolish?
Like reprogramming the pain response entirely.
Exactly. What if you actively started seeking out small, manageable losses and rejections in your daily life?
Oh, like asking for a discount at a coffee shop you know you won't get.
Yes, or pitching an idea in a meeting that might get immediately shot down.
Yeah.
Exposing yourself to mild embarrassment, purely to train your nervous system not to panic when the truly monumental moments arrive.
That's powerful.
Because whether you're sitting at a roulette table, staring at a multi-million-dollar trading terminal, or just navigating the complexities of your own life, if you don't recode your natural instincts, the house always wins.
And the only way to consistently beat the house is to realize that the real game is happening entirely inside your own head. Until next time.